Bring this up a little bit. Okay. We're going to talk about the demise of banking, and real estate, guys. This is where opportunity comes from. Look, I'm going to give you guys massive gold this morning. I was sitting back thinking, I have Alec here. Alec comes over every Saturday. We do a lot of video content creation on Saturday mornings here at my home office. And one of the big things is I'm always thinking about, okay, what do people need? Like, what is it that the general public that are investors, like if I was brand new, looking into real estate, and I really wanted to just crush it. Like I wanted this to be my real exit strategy in retirement, whether that's a year from now, 5 years from now, 10 years from now, 30 years from, whatever it is, whatever that number is for you, depending on your age, depending on where you are mentally, financially, whatever it is. What is it that I would be looking at right now? And most people don't even know where opportunity actually sits. Like you see all these folders right here that you guys are looking at. Every one of those is a project. And those are my newer projects. Like once they're older projects, they get filed, right? Like these are all projects that are pending. And like we just picked up a lot right now in Phoenix, right in downtown Phoenix. 1940s build, 4 homes. We're going to level them. We're going to put 29 units up. It's a little tiny project. We'll make between $3 and $4 million. It'll take us about 14 months turnkey to make about $3-4 million extra dollars, right? And so when I say that, people are like, oh yeah, just $3-4 million extra dollars. Yeah, just $3-4 million extra dollars. Like one of our little tiny little projects. You know, it's not like our West Camelback project, one of these big ones, you know, where we have a $70 million development going up. Easy stuff you guys can do. But like, how do you get into that stuff? And is that where opportunity really is? Kind of. Okay, so let's talk about this. How are banks falling? I predict that there'll be over 300 regional and community banks that fail in between 2024 and 2025. There'll be over 300 nationwide. And right now, the FDIC already knows who these banks are. And it has to do with their real estate portfolio, how they lent money, and how increased interest rates and the expense of money, inflation, and how much money has been printed that's going to be the variable that takes these banks down, okay? And so anytime a bank gets money from you, okay, if they get $100,000 from you, that is equivalent to $1 million on their books. And they account for it the second you deposit that money. Now, once you deposit that money is really tough to get back out. Like if you gave the bank $100,000 today and you went in on Monday morning to go try to take that money back out of the bank, it'd be very challenging for you to walk out of there with $100,000 in cash on Monday. It'd probably take about 3 days for you to really get about $100,000 in cash back out of the bank that belongs to you, okay? And it's because once that money goes in, that $100,000 can be lent on 9 more times. So that's 10 times. So that $100,000 on the bank's books is $1 million, okay? Now, here's where opportunity comes from, because the same place, ladies and gentlemen, that the banks get opportunities where you guys get opportunity, but the same thing that distresses real estate for you guys is the same thing that also distresses real estate for banks and financial institutions. Now, the big guys, you know, when you talk about the Goldman Sachs of the world, those guys get less effective because those guys are running the Federal Reserve. And that's why money printing becomes more desirable to the banks, because when they're in financial distress, well, they just print more money. Okay, now, I don't care if they print more money. Inflation is going to happen, because if the more money that gets printed, the wealthier I get. Now, it sucks for the middle class, and it really sucks for people that are living in poverty, because how much is a loaf of bread? How much is a box of cereal? How much is the gallon of gas at the end if the end consumer has to pay, right? Now, when inflation happens, rent rates go up. You guys have to pay that. We as a landlord, we land up benefiting from it. So how do you become somebody who's on the winning side instead of the compromise side? Now, it does suck for us too. We sit back and go, damn, really? Like I go to the grocery store, and for $200, I get like $100 a bag for groceries now. And it's crazy, right? But that's the world that we currently live in right now. Now, here's where opportunity comes from, ladies and gentlemen. Look at this. I'm going to underwrite a deal. Now, understand that this is a little bit higher level, but the concept is what's super important for you to grasp today. I'm not going to go through it where I break down an entire financial breakdown for you guys. I just want you guys to really understand where the demise of banks and real estate is coming from, so you understand not only where the demise is coming from, but where the opportunity lies in front of you. okay? The opportunity that lies in front of you, okay? Now, if you guys have seen me speak around the country in different cities, one of the things that I've been talking about right now is educating people on where opportunity truly does come from. Now, when cap rates go down, values go up, okay? Now, cap rates run in parallel to interest rates because a cap rate is the amount of return that you make on your money. So if you go in and you pay $1 million for a small building and you're making 10% on that, that 10% is your cap rate. If you're making 8% on it, that 8% is your cap rate. If you're making 6%, that 6% is your cap rate, okay? On the money that you spent buying that asset, provided you paid cash for it, okay? Now, if you didn't pay cash for it, you have a bank loan. And if you are paying a mortgage on that loan and that mortgage, let's say, is a 7% interest rate, how do you pay a 7% interest rate if you buy the asset at a 5% cap rate? You can't. That's running, right?
Yeah. Yeah.
It's running?
It says it is.
Yeah. How many people are on there?
I'm not seeing anybody right now.
Okay. Just let it run. Is that Twitter?
This is TikTok, but
bro, if there's, let me see here.
It says it's live.
Yeah, dude, don't fuck with it. Just leave it.
I don't see that anybody's on there. I'm just making sure it's all good.
Yeah, probably is not. Let's see. And now, yeah, 0 fucking people, bro.
That's why I was looking at it to see.
Yeah, let's see here. Let me go.
What's my fucking dog? I don't fucking.
Okay, let me see here. We have like cussing animals today on this thing. Okay. Now we go live, bro. It wasn't on my page. Just go live.
Oh, it wasn't on the right one? Or what?
No. Okay. Cool. We go live. Boom. 2, 1. Okay. Cool. That should do it right there.
Okay, cool.
Okay.
I just have been making
don't even mess with it. Just let that roll now. I don't know why I was doing that. Okay. So when you go out and you buy an asset, at a 7% interest rate, you can't buy the asset for a lower cap rate. The cap rate has to match the interest rate. So that way you can service the debt on the asset. And the vast majority of people aren't buying buildings and apartments cash. They're leveraging them from the banks. And so you have to have a cap rate that runs in parallel with that interest rate. Okay. Now, here's what happens, ladies and gentlemen. When cap rates go up with interest rates, values go down. Okay. Now, this is what most people don't realize. Okay. They say, well, no big deal, Jerome. Cap rate, I'm just going to make, actually, it's a good thing because if I have an increased cap rate, my rate of return goes up, right? And so you sit back logically. Now it's going, right?
Yeah.
Yeah. Okay, cool. Okay. So when you sit back and you go, well, Jerome, why is that an issue? When cap rates go up, now if the asset was at a 4% cap rate, I'm buying it at a 7% cap rate to service my debt. Now I'm making 7% on my money versus 4% on my money. And yes, that is 100% true. That's 100% true. Your cash flow increases, but your value gets friggin' crushed. And what this does to financial institutions is they get annihilated because there's millions and millions of loans that are coming due this year. In 2024, 2025, the loans mature. And a lot of these syndicators, what happens with a lot of investors is they do these 5-1 arms and they go in and they leverage a 5-year fixed rate mortgage. So when interest rates were really low and they were at 3%, they bought these assets at 3% cap rates. They bought them at a 3% interest rate. Now, when that loan matures and it's a floating arm, now the interest rates go up to like 7%. Now, if they bought that thing at a 3% cap rate, how do you service the debt with a 3% cap rate on a 7% loan is the big question. And so you can't. And so they go into financial distress. Now, this is not only where it comes from. So watch, I'm going to do a whole cost breakdown here for you guys and show you where office is just getting plummeted right now. Okay. Now, let's take a real simple example of a value of a property. Now, value, the way you figure out value on a commercial asset or a residential asset that's an investment asset is value equals the net operating income divided by the cap rate. Okay? That is value. Okay, so you just don't sit back and go, well, Jerome, that's impossible. It would take me $1 million, $2 million to build this asset. It has to be worth at least $2 million. Beep. Nope, wrong, completely wrong. It's not worth what it costs you to build it. The value of an asset is what it produces in cash and revenue so that you can service the banks. The banks want to know, what is this thing worth on a financial basis? It has to pencil financially in order for a bank to be interested, because the bank doesn't want a building. They say, well, I own these 4 walls. Who gives a shit? The 4 walls don't produce money. It's like a printing machine of cash, right? That asset has to produce cash for the bank. And this is the way the human average person should think, but they don't. They sit back and get excited. Oh, I got a house, right? I got a house. I got 4 walls. Who cares? The 4 walls are worthless unless it produces cash, unless it produces revenue. That's the only way that a house is worth any money to somebody. Now, an end user, like the house I live in, go, okay, cool. I got a $3.5 million home. Great. Well, it doesn't produce cash. So yes, to the end user for this one single family home, if it's your end house, it has some value to it. But when you're looking at an investment property, if it doesn't produce cash and you're looking for a commercial loan on it, the portfolio to the bank is worth absolutely pot shit. It's worth 0. Okay. You need revenue. And so revenue comes from the net operating income. So the operating income is all the cash that you bring in minus all the expenses. That does not include debt service. That is just all the expenses, the lights, the insurance, the property taxes, all of the deferred maintenance, parking lots, rooftops, paint, clogged toilets, all of that stuff, all of your expenses subtracted from the gross revenue that comes in equates to how you figure out your value. Okay. Now, here's what happens with real estate right now. Let's say that you go in, and let's say theoretically we have an apartment complex, and realistically, for the average consumer going out there buying their first set of deals, they may not go out and buy a 100-unit apartment complex. But can we agree that it's not taboo for a new investor to go out and maybe buy like a 10-unit apartment complex? Reasonable? Let's do this. Let's break this down from like a 10-unit apartment complex. And then I'm going to show you guys this as if it was a 10-unit office building and show you how banks are just getting friggin' crushed. And then all you need to do is multiply that 10-unit deal to like hundreds of units, right? For like to scale it in magnitude. So we go in and we go 10 units times $2,000 a month. Let's say we have some 1-bedroom units that are like $1,700 a month. We have some 2-bedroom units like $2,200, $2,300 a month. Let's do $2,000 a month. Okay. So we have 10 units times $2,000 a month. So 10 times 2,000 is $20,000 times 10 times 12. There's 12 months in a year, ladies and gentlemen, 12 months in a year. Okay. That's $240,000. Okay. Now, I'm going to hold this. You guys look at this right here, this formula right now. Now I'm going to come right back to this. We're not leaving this. We're coming back to this. Okay. Now we go in, we say 10 units. And this is equivalent to $2,000 per month rent. Okay. That means our gross income potential equals $240,000 per year. Okay. Now, our gross income potential, that's what we're doing potentially right now. Let's say we take our gross operating income. This is the actual, all right? This is its potential. This is the actual. Okay. Now, let's say that this asset is 95% occupied. So let's take 95% of that, because 5% of it, typically commercial real estate, especially multifamily, it has about a 5% revolution monthly. So if we take 95% of that, so times 0.95, that's $228,000. Okay. So we have $228,000. Now, typically, an underwriting number is 40%. It typically takes about 40% of the gross operating income to be able to manage, maintain, and service all expenses on an investment property taxes, trash service, water, electric, insurance, all of those things are included in your expenses. So now we go in and we say our expenses are 40% 40%. 40% of the GOI, the gross operating income. Okay, so let's take 40% of that. So times 0.40, that's $91,200. Okay, so expenses equals $91,200. Now, we're going to take, now our NOI is our GOI. So NOI, our net operating income. This is the formula, guys. NOI equals gross operating income minus expenses. Okay, so we're going to say our NOI is going to be equal to the $238,000, 228 minus, let's call it 91K. Let's just round this thing, guys. Okay. Okay, so we take 228. That's $136,800. Okay, so our NOI equals $136,800. Okay, this is the number that's important right now. Okay, that's the number that's important. Can they see this in blue? Can you guys see this in blue?
Yeah.
Okay, so $136,000. $136,800. Black is better. That's your NOI. Okay, take a picture of this, guys. Take a screenshot of that. Okay, now we're going to take this number, our NOI, $136,800. Okay, so we're going to go back to this other one. Okay, now value equals NOI, $136,800. Okay, now divided by the cap rate. Okay, now let's look at this number in 2021. Okay, so 2021 value, even 2022, part of 2022 value. Okay, let's say that these guys bought this at a 3% cap rate. Okay, divided by 3%. Okay, now that's going to equal, the value is going to equal divided by 0.03. That's a $4,560,000 value. Okay, $4,560,000 value. Okay, to the banks, to everybody, right? So you go in and back in 2021, you could go in and get an 80% loan to cost. The bank would give you, so times 0.8%, so times 0.8, 80%, so times 0.8 would give you $3.6 million, right? So the bank, so this is the value 2021. Bank will give you 80% loan to value. Okay, they're willing to give you $3.64 million. $3.64 million from the bank. That's from the bank. Okay, now, look, ladies and gentlemen, nothing's changed. People still need rooftops. In fact, there's a shortage of them nationwide. And one of the big things is that the walls are all the same, ladies and gentlemen. There's no difference to the real estate. You go by the same exact apartment complex, the same exact office building. The walls have not changed. The parking lot looks the same. The exterior stucco looks the same. The grass is still mowed. The tenants are the exact same tenants. The cars that were in the parking lot in 2021, same cars that are in the parking lot today. Nothing's changed. The rent amount that the tenants were paying in 2021 is the same rent amount that they're paying today. The same $2,000 that they were paying then, they're still paying now. Nothing's changed. Everything is 100% the same. Except for one thing. There's only one variable that's different. Occupancy is the same. Vacancy rate's the same. Rental income's the same. The amount people are paying, the asset itself, no difference. 100% all the same except for one single variable. And that one single variable, ladies and gentlemen, is the interest rate in its relation to the cap rate. That one variable, watch what it does to real estate. This is what people got on a 5-1 arm. This is what banks were lending on this asset with this NOI. Okay, 2021. 2023 rolls around, all shit hits the fan, interest rates start raising faster and quicker than they have in 40 years. Okay, so we start seeing interest rates just ding, 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 ding. See, because interest rates are not high right now. They're not expensive right now Because right now, interest rates are running in parallel to where they were when our economy was at its strongest in 2006, and our financials, our banks, were at the strongest that they ever were historically. And so interest rates were hovering right around 6-7%. They're the exact same as they were then. The difference is that interest rates haven't rose this quick in over 40 years. So we went down to sub 3%, and then ding, 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 they stacked back up to 7%. Like in 12 months, just boom, boom, boom. The Fed just started raising interest rates, and people and investors and banks sit back with, holy shit, like ding, 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 ding. And they're like, cool, I'll just hold my assets. 1 year goes by, 2 years goes by, 5-1 arms start to expand because people were buying in 2019, 2020, 2021. Now we're in 2021, 22, 23, 24, 25. Ladies and gentlemen, over the next year, we're going to start seeing these 5-1 arms mature. When these 5-1 arms mature, this, ladies and gentlemen, is exactly what happens to the banks. Now, 2023. Or we'll say 2024. Doesn't matter, right? So interest rates are supposed to lower. We're hoping they lower fast enough to be able to prevent some of this, but it's still not going to happen, guys. Over 300 financial institutions are going to get socked in the gut and lose their air, right? They're going to get killed in this. The FDIC is already watching it, okay? 2024, interest rates go up to 7%. Let's just call it 6%, okay? We'll call it 6% interest rates. Okay, now, again, you can't service a 6% interest rate on a 3% cap rate. So cap rates, interest rates have to run parallel. So 3% interest rates, 6% cap rate. What is value? Value is NOI divided by cap rate. So you take this exact same NOI. Nothing's changed, right? Nothing's changed. But we're going to take a 6% cap rate. In theory, you're like, great, I make more cash flow. 100% right. You do make more cash flow. You make double the cash flow. But here's what happens to values. You take that same $136,000 divided by a 6% cap rate times 0.06. Boom. The value of that asset today with no changes whatsoever to that asset with zero changes, $2,266,000. So 2024 value, $2,266,000. That's the value, guys. Now, let's say you can't even get an 80% loan to value anymore. So let's say you're lucky enough to get a 70% loan to value because this is happening. Like banks are scared. They're sitting back. They're going, well, shit. Except for the big guys like Goldman Sachs, Merrill Lynch, all the big guys, they're sitting back going, they're sitting back printing cash because they run our Federal Reserve. People, it's unconstitutional, but yet the central banking system runs the Federal Reserve. It's a non-governmental agency. I've been talking about this to people. I've been talking about this in front of a room since 2018, and people don't listen. But I'm sitting back going, guys, listen up. This is the way our world works. This is the way the United States works, right? So the central banks are running our economics for you, okay? Now, it's crushing all the small banks. And so what ends up happening, guys, is now, how do you go out and service this loan that was written in 2021 if the value can't even get there? Because a bank now isn't giving 80%, they're giving 70%, 70% loan to value. This is what a bank will lend on that asset. So you take that $2,266,000. One, two, three. This calculator doesn't have commas on it. Okay, so you take times 0.7. Sorry. Okay, 2,266,000 times 0.7. Okay, the banks are only willing to lend $1,586,000 on that asset. Okay, so 1.58. Okay, so let me do it the same way. $1.58 million from the banks. That's all it's worth, guys. It's no longer worth that to the bank anymore. Bank's not going to give that money. That was 2021 money. This is 2024 money. Same asset, guys. No difference. How in the friggin' world can that be, right? Like, how can that be? Now, that's how it affects you. That's how real estate's getting crushed right now. Okay. Now, some people are saying, oh, if you're an owner and you have real estate, the only way you lose is if you sell. See, I look at real estate, I'm like, yeah, who cares? I get my rents every month, just sit on it for a while because I don't do 5-1 arms. I'm not syndicating like that. Everything I buy, I hold forever. So if I get a 35-year HUD loan, I don't give a shit. Just sit on the damn thing. Like, who cares? I have 35 years set in at 4%. Who cares? I underwrote it at 8% cap rate. I'm good. I'll just sit on this thing, baby. I'll just let this thing be a cash producing machine. Just print cash for me. Boom, 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 boom. But syndicators have a 5-1 arm. We're expecting to make their spread a profit at the end of that 5 years, 3 to 5 years, what they hold and sell. How do you sell? When you pay this, how the friggin' world do you sell to somebody? They can get a loan like this. Okay. Now, that's the value to the banks. The banks did it. The banks have ownership of this. Now, the banks are sitting on mortgages that they gave mortgages like this to. This is how the banks get crushed. Banks gave loans, guys, on this. But values only sit here. So the bank is looking at the difference between this spread, the 3.64 million, and the value of 2.26 million. And they're sitting back going, holy shit, we have a deficit on our books. We have a deficit of $1.3 million on our books on this one asset. And they have thousands of these assets on their books, millions of these assets nationwide. Okay. So that's just one, guys. Now, let me show you what else happens. Okay. Now, this is how office is getting crushed. Okay. So you guys see this? You guys understand this and appreciate this? If you do, comment below. If you're watching this on a repeat, put hashtag repeat. Now, ladies and gentlemen, look, if you like this content, you want more like this, then pound the thumbs up button, click and subscribe to our YouTube channel. And I'll tell you guys, look, I'm going to show you guys something here. This is where office is getting distressed. Check this out, guys. So this goes on. This whole ruckus goes on. But now you take this 10 unit where you took a 95% occupancy. 95%, guys. 95%. That's what that says. 95% right there. Okay. 95% occupancy. COVID hits. 2019. All shit hits the fan. Everybody goes home for over a year. The bosses call back up, say, hey, it's time for you to come back to the office. 40% of office never friggin' returns. Never returns. So if office was functioning at a 90 to 95% occupancy rate, let's say it was functioning at 95%. It wasn't. It was functioning closer to 91%. But let's call it 95%, okay, just for the sake of example. 95% occupancy on office. COVID hits, 40%, ladies and gentlemen. Those are real stats. 40%, they never come back. It never comes back, ladies and gentlemen. In fact, 40% of office stays vacant in addition to what it was already. So 45% of office has nobody in it nationwide. Okay. No tenants, no cash flow, no nothing. It is functioning on a 55% occupancy rate. That's the national average right now of office nationwide. Okay. So now we take this 95% that we underwrote this at. And so we take that and we go down to 55%. Okay. 55%, ladies and gentlemen. Now, here's the kicker, is that our expenses don't change. That 40% is on a healthy asset. So this expense, the expense that it takes, still exists. That doesn't change. So it's still going to take the same $91,000 for insurance, property taxes don't change. None of that shit changes. That stuff stays the same. Okay. But the occupancy goes down to 55%. So now we take our gross operating income from 228. We have our gross income potential of $240,000. And you take a multiplier of that. So times 0.55%. So times 0.55. That's $132,000. Okay. $132,000 on our gross. So that comes out to $132,000, ladies and gentlemen, on our gross operating income. Okay. Okay. Now, We still have these expenses of $91,000. Remember, our NOI equals our gross operating income minus expenses. So now our gross operating income is, this no longer exists, okay? So our NOI, our new NOI is going to be equal to $132,000 minus our $91,000 of expenses, right? So minus expenses, our net operating income minus gross operating income minus expenses equals NOI. So minus $91,200 is our expenses. This is our GOI, our gross operating income. Okay, so minus 91,200. Our new NOI, guys, our new NOI, can you guys see this down here? Yeah, you guys can see this. Okay, our new NOI is equivalent to $40,800. $40,800. Oh my God, office is getting friggin' crushed. Okay, now that's not it. Our net operating income is $40,800, right? Now, let's look at this again from a perspective, right? Let's look back at this one before we actually figure this out, guys. We had a gross operating income of $136,800, and we, in 2021, when we were sitting back at a 3% cap rate. Let's look at our cap rate today. Look at this value, okay? The value is $2.26 million in 2024, provided that it's a healthy asset. That's apartment complexes, guys. These are apartments right here. This is an apartment scenario, okay? Let me show you the office scenario why banks are getting crushed, because over 40% of the banks are invested in office. And so 40% of their commercial portfolios are getting friggin' annihilated right now. So $2.26 million value went down from $4.5 million already. So let's just take this at a 6% cap rate, ladies and gentlemen. So remember, value, so $40,800. Okay, remember $40,800. Our NOI equals $40,800. Okay, that's annualized. Now, value, just for a refresher, equals net operating income divided by cap rate. 2024, cap rates are at 6%. So 2024, we're going to take an NOI of $40,800. That's our NOI. Divided by a cap rate of 6%. Value equals, who wants to do the math for me? Divided by 0.06, $680 friggin' $1,000 is the value. Office, ladies and gentlemen, office. That's office. That's a real friggin' number, guys. That's a real number. How in the world do you take a healthy asset? Nothing's changed, guys. Nothing has changed. Everything's the same. 10 units, $2,000 month rental income. This changed for office. It changed, but a healthy asset, a healthy apartment complex. You're sitting back, not bad. 2,000. Really good. That same asset is an apartment in 2021 was worth $4.5 million. Office, $680. Today's real world apartment, healthy asset, still getting crushed. $2.26 million, ladies and gentlemen. $2.26 million. Office, 55% occupied. Millions and millions of office buildings all over the country. $680,000 value. Ladies and gentlemen, if you can figure out a way to strategically reposition office, this is how you crush it. We bought an asset. We overpaid for an office building in Youngtown, Arizona, back 2 years ago. We picked it up for $1.8 million. Shouldn't have paid more than about $1 million for it. We paid full sales price plus $200,000. We turned that asset, we spent another $12.5 million renovating that asset and turning it into 104 units of apartments. That asset is now worth over $30 million. We're doing a stabilized HUD loan on it at 5-point-something% interest rate. We haven't finished closing on the loan. We're about 80% occupied. We're still about 2 months from being 100% fully stabilized. And that asset's worth over $30 million. And we turned a $1.6 million office building that we overpaid for into a $31 million apartment complex. And so, ladies and gentlemen, there is opportunity in this. You can't even buy the land for this. If this isn't primary, just buy it for $680,000, friggin' scrape it, and then build something that makes sense. Now, ladies and gentlemen, this is what's happening to banks. This is what's happening right now, not just to banks, but investors, individuals. Real estate's getting crushed, and so are banks. When there's distress in the market, there's opportunity. And understand that the opportunity is up for the taking. It's up for those who are willing to put in the time, strategically get the wisdom, understand what I just talked about today, and go out and execute. Because actions without results mean absolutely pot shit. They mean zero. They mean nothing. Ladies and gentlemen, right now, we have about a 2-year opportunity. And people hear us talk about it, but they don't hear us explain it. And today, when I was laying in bed, waking up this morning, I thought, what can I record today that would move the needle for investors? Investors that understand that they want a return on their investment, but really don't understand exactly where that return comes from and where opportunity and doors open. By the simple means of understanding, the underwriting that I did today will help you better understand how to strategically position yourself to invest and crush it in the market. And you don't need folders full of deals. You want, guys. Focus on this. One deal. One deal can change your life forever. For those of you guys who haven't heard my Tolleson story, back after 2008, my retail was kicking my ass. And I was almost at a point where I turned to my wife one day and I go, babe, don't shop at Neiman Marcus and don't shop at Ross. Because if you buy a $100 blouse at Neiman Marcus and $10 blouses at Ross, it's the same thing. It's $100. We need it. Because right now we're servicing 6 figures in debt every single month. And I don't know how long we can sustain this. So we have to figure out what commercial assets we're willing to let go of. And by the grace of God, I worked my ass off. I figured all this stuff out on my own. And by the grace of God, we scraped by, barely. Didn't lose anything, and we moved through it. I went out and started buying real estate 4 months later. And in April of 2009, I was buying distressed assets in Phoenix. I bought a portfolio that I invested $980,000 of my own money from buying land and building houses into a portfolio, $980,000. I got a cash out refi on it, pulled 100% of my money back out and let my money go back to work for me and started buying Subway stores. I let those assets sit from 2009, 10, 11, 12, 13, 14, 15, 16, 8 years. 8 years later, I take that portfolio to the market and I sell the entire portfolio for $3.8 million. After I pay all the commissions, all the closing costs, everything, I land up with about $3.3 million in my pocket. I tripled my money, ladies, more than tripled my money in 8 years. I took that money, I did a 1031 exchange into an 86-unit apartment complex in Tolleson, Arizona. Bought that asset for $7.2 million. I bought that asset at an 8% cap rate in 2016 because that's what cap rates were in 2016. I cashed out, refinanced that asset in 2021. We own it today at a 5% cap rate, took $5 million cash out on it, and we appraised that asset at over $15 million. Ladies and gentlemen, that thing still prints cash every month, every month, every month, every month, every month. One deal. $980,000 turned into over $15 million in net worth. One deal. That's one. We have tons of stories like that. That's just one. You don't need a bunch of them. All you need is one. Opportunity. Ladies and gentlemen, go out and crush your Saturday. God bless you guys. Go out and compound your success.